As you can imagine, the Federal Reserve is watching how this tariff spat plays out and how it may affect the economy. And right now, market expectations for a rate cut are changing. Steve Liesman has more.
In the wake of new tariffs from President Trump's on Chinese goods and Chinese retaliation on U.S. goods, markets are now pricing in a quarter-point cut from the Federal Reserve by October and maybe as soon as September. The probabilities in the Fed fund markets now price a 50% chance of a cut by September, 60% by October, 75% by December, and 90% by January 2020. But for one Fed official, it's too soon to make that call.
I'm hopeful that cooler heads will prevail and this won't go down a very nasty path. Obviously, if it's the worst case scenario and it's ever increasing tariffs for an extended period of time, that could change things. That could have a real effect on U.S. GDP growth. But right now, I'm not seeing it. And so I'm in a wait and see mode.
Gauging the economic impacts of tariffs is hard enough. The Federal Reserve also has to weigh the probabilities on the outcome of negotiations, whether or not there's a deal, how long tariffs could be in place, how equity markets respond, and the economic impact of lower stock prices, and the effect of all this on business confidence and capital spending. J.P. Morgan in a report writes that the trade war could hold global capital spending growth to zero this year and dampen Chinese GDP by 0.8%. The escalation of the conflict could also amplify an easing bias, that is, rate cuts across the globe. All of this leads Morgan Stanley to forecast serious easing by the Federal Reserve of interest rates. If the trade battle lasts 3 to 4 months, Morgan economists see more Chinese stimulus and 50 basis points or a half a percentage points of cuts from the Fed. For Nightly Business Report, I'm Steve Liesman.